Section 10 Foot 38 of the Income Tax Act in India deals with the exemption on long-term capital gains, LTCG, arising from the transfer of equity shares or units of equity-oriented mutual funds. Here are the key details. Applicability. The section applies to LTCG arising from the transfer of equity shares in a company listed on a recognized stock exchange in India or units of an equity-oriented mutual fund. LTCG is calculated as the difference between the sale consideration and the cost of acquisition of these assets. Exemption criteria, as per Section 10 Foot 38. LTCG on such assets is exempt from tax if the following conditions are met. The transfer of shares or mutual fund units should be a long-term capital asset. For shares, this means holding for more than 12 months, and for mutual fund units, it's more than 12 months. Securities transaction tax (STT) should have been paid at the time of transfer. This condition ensures that the exemption is applicable only to transactions conducted through recognized stock exchanges, where STT is levied. Exemption limit. There is no upper limit specified for the exemption on LTCG under Section 10(38). However, it's crucial to ensure compliance with the conditions mentioned above for claiming this exemption. Changes in taxation. Before April 1, 2018, LTCG from the transfer of equity shares or mutual fund units was exempt from tax. However, after this date, LTCG exceeding 1 rupee lakh from such transfers in a financial year became taxable at a rate of 10%, without allowing the benefit of indexation. This taxation applies only if the gains exceed 1 rupee lakh in a financial year. Indexation benefit. While LTCG from equity shares and equity-oriented mutual funds became taxable after April 1, 2018, they are still taxed at a flat rate without the benefit of indexation, unlike other long-term capital assets like property or debt-oriented mutual funds.